Good afternoon and welcome to today's conference call on commercial real estate today, perspectives from the banking and institutional investor communities. My name is Bill Garber, Director of Government and External Relations for the Appraisal Institute, and welcome to today's call. We're going to have a conference call for 60 minutes today. The call is being recorded. It'll be available on the Appraisal Institute's YouTube page for post-listening. We will be taking questions at the end of today's program. You can submit a question using the Questions tab in your GoToMeeting dialog box. And if there's any other questions along the way, you can submit a question to the panel or to myself using that same button. I'd like to talk and welcome our panelists and our speakers today. Sharon Whitaker, Vice President of Commercial Real Estate and Mortgage Finance with the American Bankers Association. And Keith Strohl, MAI, Vice Chair of the Valuation Committee of the National Association of Real Estate Investment Fiduciaries. Sharon is an accomplished leader and executive with over 30 years of experience in risk management and mortgage, consumer loan, and commercial credit portfolios. We know her well because she's been dealing with appraisal issues at the American Bankers Association for many years, and is a frequent speaker to appraisal audiences and a go-to resource on commercial real estate and valuation topics. Keith is also the principal at NPV Advisors, and he was the founder of one of their offices on the West Coast. He has a range of experience in providing consulting services to lenders, pension funds, and corporations, and completing quarterly valuations of a $2 billion portfolio for Prudential Real Estate Advisors. So I appreciate your participation in this afternoon's discussion. I'm going to go ahead and turn it over to Sharon for some initial comments from the American Bankers Association. Sharon, welcome, and thanks again for joining us today.
Thank you so much, Bill and Justin, for having me and Keith here to really talk in general about the commercial real estate market, and really specifically what I want to focus on a little bit is where our lending community is at. This is a great venue. I'm not going to pretend I know more about what's happening in the values of the market than those of you on the call. So I will, ask you to give feedback and, verification or validation or challenge any comments that I'm saying. What I'm saying is I'm talking about my personal view on what's happening. In no way does this necessarily represent the view of the American Bankers Association. So with that said, I want to start a little bit about where we are in the commercial real estate market and the performance of it. We're at and have been at really a very well-performing commercial real estate portfolio for our member banks, for all the feedback that we've received really all the way through 2022. We're looking at extraordinarily low delinquencies. Non-performing indicators are near historical lows. So I think that as we set the table, and we're reading the articles on a lot of the softening around the edges is what I like to call it. Yes, there are areas of concerns. I'm going to go out into areas of concerns that the federal regulators are beginning to look at, and where some of our members are as well. I think that that's somewhat important for us to really think about as we talk about the pandemic. So much of the shutdown, so much of some of the commercial sub-asset concentrations really began to slow down. Then in came some government monies, PPP program, which really helped to stabilize that market, as well as those who make these commercial real estate loans, really giving some short-term and long-term modifications to help their borrowers through it. As one banker said to me, really, Sharon, we have so little in non-performing at the moment. Those that we're seeing really had some management issues prior to this. But with all that said, the industry really is taking a very forward-looking position on performance, as I mentioned, in some of the specific subsectors. They're not just looking at financials today, but they're looking forward for renewal risk, maturity risk, those that may be refinancing out, and where the expectation for that performance may go in the future. And there is some very robust stress testing being done from the bottom up, not only looking at this increased interest rates that were, that are 475 basis points, I believe, from where they were, and how those loans are going to perform under their debt to income, their debt service coverage ratio, wrong half of the brain, and how they're going to perform not just with the interest rate for that piece of repayment that's going to impact their net operating income, but as well, expenses keep creeping up as well. So banks are shocking. There are different sectors of the portfolio, individual loans, to look at where do we need to remain focused on and what's going to happen. With that, I'm going to pause for a moment because I was late in March. I was at an ABA event in December, and all three federal prudential regulators were on site: OCC, Federal Reserve Board, and the FDIC. And as they each spoke about their top three concerns in safety and soundness examinations at banks, each one of them specifically talked about commercial real estate lending. So I want to give you a little bit of an insight for 2023, what their top priorities are, of what they're looking at for different credit types that are going to require or are requiring increased oversight. And it really coincides and aligns with what our members are looking at. Credits with tenants, that's broad-based. It goes across the board. That is one that they specifically said. Office, obviously, retail, central business district. They're looking at maturity risk, which I mentioned a moment ago, as well as hospitality. Multifamily has performed very well, but there is a little bit of a concern industry-wide that in some central business districts that rents may not be keeping up with the repricing of these loans. So that's giving a little bit of a pause. I won't say it's in the center yet, but something to think about. Concern over ADC, acquisition development construction loans, and pre-sold. Is the takeout still going to be there on pre-sold? Will the buyer still be able to afford it? Location, they want to make sure there's diversity within portfolios. Very important to look at. Our members still saw some good strength in medical office, multi-tenanted properties. They were still feeling very comfortable in that, where it may not be a single tenant that you may lose, but within your community, how is that community itself performing? Storage space obviously is still strong, and medical space, if I didn't say that earlier, I did want to talk about that a little bit. So with that said, as we look at the concentrations, and I guess we should maybe talk about when we're looking at declines in values, how lenders of commercial real estate that's in their portfolio, how their expectation of the values which you're involved in will perform. And I was talking to Bill and Keith about this right before you all jumped on. And recently in February, I was listening to the Federal Reserve Board, and we were talking about, loan to value and leverage ratios currently. And many of our member banks are very conservative. Not everyone's totally conservative. But if you're looking at a leverage at a loan to value at origination of 65%, and I'm going to talk about office because we're all reading articles and you're the experts, you're re-looking at some of these properties that may have been leveraged at a 65% LTV. If we're looking at a 15% decline in value, that loan to value equates to approximately 76%. If you had a 75% loan to value at origination, they're estimating a 15% decline in value to go up to an 88% loan to value. So depending on where institutions have levered and lent in specific sectors, they're diving in and looking at that a little bit more deeply. If it drops 25%, a 65% LTV goes up to 87%, and a 75% LTV with a 25% decline in value goes up to 100%. Those are just a couple of quick examples of what we as credit managers, risk managers need to dive down and take a stronger look at. How is this all going to impact? It's not obviously just the debt service coverage and that ability to repay. Net operating income will be impacted and across the board. But what we're looking at future values and what properties may need to be touched as the lenders are re-looking at those original appraisals that were done and assessing those specifically for, is there a difference in the market area? Is there a decline in this credit? Do we need to retouch this and order a new appraisal? But I pause there because you are the experts and you really have most of the data regarding that. We saw a slide the other day about cap rates really beginning to increase. So that is a concern in the market. They've been extraordinarily low. Some have said artificially low for a very long time, and we're beginning to see that creep up in some of these sectors specifically. I know that many are really focused, as I said, on monitoring these credits when these rates are going to reset. They're not just looking at next 6 months. They're forward looking to loans that may reset in the next 3 years who may have that really low, what I'll call a legacy rate. And so that's changed a lot in their approach to new credits. And it's changed a lot in their review and annual oversight of the credits within their portfolio and the credit risk area. I am going to try not to talk for 50 minutes on this, but I don't know if you're looking for a deeper dive in asset management and exactly how banks really try to have an oversight of this or when they may trigger to order a new appraisal. I will say most of our banks have now adapted CECL versus their typical ALLL, the asset. Okay, ALLL is really the capital that you're going to hold against a specific group. CECL really goes down, which has now for almost all banks, it actually drills down to the subsectors of the loan in similar tranches and how much capital you hold against that in a whole. The new CECL calculation is expected to keep up with loan losses on a forward-going basis as banks have now picked up this new methodology for how much capital needs to be held against these banks. As I said, it's been clean thus far, but it is something that we need to keep an eye on. I'm going to pause, and Justin, you said you didn't want to talk, but I want to ask you, as a person involved in this, are you seeing the same type of thing aligned at your bank?
Yeah, we just had an FDIC exam, targeted appraisal and credit last month, and that was one of the things that they're asking us about, shocking these things and stressing these things and looking not just what we have here, but what's going to be, maybe in the next few years. So very much, and targeting where we're a $21 billion institution, and so we're a regional bank, but asking us what's your portfolio look like? Do you have where what are you concentrated in, and should we worry about office sector, retail, housing, whatever? So that's what I've seen, the same thing that you've mentioned.
Excellent. So to expand on that just a little bit, when Justin gave a perfect example, those asset concentrations, those sub asset concentrations, whether it's office, retail, the ones I mentioned, banks actually have a policy that is written for these sub concentrations. Not only do they manage commercial real estate at normally a 300% of risk-based capital, but they also set within their policy, within specific concentrations, multifamily office space, a percent of risk-based capital or a percent of their loan portfolio where they begin to slow down in lending in some of these sub assets classes, as well as if the economy is kind of turning a little bit and there may be a downgrade because you have to risk rate these loans. If there's any type of downgrade in these sub-asset classes, that may cause a bank to slow down in lending in these sectors. So our members are very conscientious about office space and I want to make sure I get this slide right in my head that I always misquote. But a slide that we just looked at that one of our econ folks put together, they basically discussed 54% of, for a week, people are in the office 54% of the time now. So as those leases are up for renewal, is there going to even be a further decline? Because so far the tenants have been paying on that office space. Some of it is sublet, some of it's dark, and there was a concern about the future cash flow there. With that, I think I covered an awful lot, and I don't want to take up too much time, and we're almost 20 minutes into the call, so I can pause and turn it over to Keith if he has additional comments to discuss.
Thank you, Sharon, and welcome, Keith. I'm going to go ahead and hand control to you. And I believe that you had a slide. And you should have that now, and you should be able to trigger it.
Thank you. I'll start with this slide, and again, I'll reiterate what Sharon indicated. These are not NCREIF opinions. These are my opinions, but it is certainly within the context of discussions we've had. But what we're looking at on my screen right now this is the returns over the last year for the NCREIF index by submarket, by property type. So you can kind of see what's happened on values. You know, if you look down the office sector where the greatest weakness is in the market right now, that's where you've seen the greatest declines. Whereas, you know, industrial and apartments have held up. Industrial better than apartments, but both have held up well. Retail took a pretty bad beating before the pandemic. So a lot of it was flushed out, and it's actually performed better than some of the other asset classes, and certainly better than it did back in when you get back into 2016, 17, 18, where the retail market was really down. I want to get off, but this will show you kind of by market what's happened over the last year in terms of total return, which is appreciation, depreciation plus income. So we've seen some significant declines in, you know, some of the ones you can expect. San Francisco's taking the biggest hit overall, and that's really being driven by the office sector. The bottom tier sections, the New York down to San Francisco, were all really driven down by the office sector. You can see that there, the multifamily, but even the apartment sector in San Francisco saw the negative returns. Bill, we can take that chart off. Let me see if. Are we back to my screen? But yeah, thank you. But what we wanted to say, I mean, we've seen across all sectors, we've seen as the mid 2022 hit and rates were moving, we had a significant, price discovery period of I'll call it the last 6 months of 2022. There was a serious lack of trades from a valuation perspective. We didn't have the transactions, but we had people take assets to market. They didn't meet their prices, took it off market. So we did have some price discovery, and we started getting some understanding of where those prices were, but the gap is still big between the buyers and the sellers. And the interest in industrial and multifamily, especially industrial, still remains stronger. Office sector, we're seeing significant weakness, significant gap in buyers and sellers, and a very lack of transactions. But there are transactions starting to take place. We're going to start seeing, we're starting to see the special servicers on the, in the CMBS side, especially some of the stuff that's gone back that is on watch and is going to probably eventually clear. And we're going to probably see a pretty significant reset in the office market. And this is pretty much across the country. But when you talk about the office market, there is a flight to quality. We're still seeing the top tier buildings in the top tier markets. The rental rates are still actually increasing. But it's the generic, the class B, C stuff, or the lower level generic suburban product. That's where we see the greatest weakness. It's certainly the class A market. There's the tenant demand and the absorption. They are capturing more than their fair share of the absorption. And it's just starting to kind of, as the premier spaces are filled up, we're starting to see a slight trickle down to, the next tier of properties in terms of demand. So, and you got to also think about it. I mean, the headline is, Google, Meta, as well as, Apple. People are laying all these technology layoffs that have taken place. But if you look over the last year and a half, what they're laying off relative to how much they've actually increased their employee headcount, they're tremendously up. So while they are announcing layoffs, they're still net positive on their total headcount when you look back over the last 18 months. So, there is demand, demand growth is still increasing. And I don't want to completely dwell on the office sector, but it is the highest, area of concern in the overall market. You've got about $63 billion of CMBS office loans coming due by 2025. Their average interest rate that they're carrying at 4.3%. Well, they can't get any debt, if you can get it on office today, is over 6%. So that refinancing risk that Sharon spoke of is certainly something that is going to be watched. That's the industrial sector. It has moved. The rates have, cap rates have moved up. They're up probably over 100 basis points since mid 2022, and that is just purely driven by the cost of capital, and the cost of capital is impacting everything. But we've also had a fundamental shift. We were coming off record rent growth for industrial. Across, the justification, I'll call it, on the East and West Coast for the core markets on the industrial sector, where cap rates got into the 3s and sometimes into the 2s. But that was a lot of it was being driven by low cost of capital, but also a significant increase in market rent. And we saw the same thing in the multifamily sector. The fundamentals behind what was driving some of those low cap rates, in addition to the cost of capital, it was also the fundamentals of the high demand. Industrial demand, industrial had double-digit rent growth. It's still, it's still in the high single digits, but it's coming down. And so we expect that to continue. It'll come back down to a normalized level as more, because there's a lot more inventory coming on into the industrial market. Multifamily also had a high run up in the market rents, which, the fundamentals, it supported the lower rates in terms of cap rates, but that is also slowing. So that is, the fundamentals are shifting on both of those that are pushing rates up. The cost of capital is going up. So you can't ignore the fact that, cap rates have to increase. And we've seen that, but industrial and multifamily still remain favorable in terms of it, but it is market to market. San Francisco's seen still softness in the multifamily sector and rents, but the effective rents are still moving up because they are burning off some of that free rent that they had to do. The retail sector, like I mentioned before, kind of got flushed out pre-pandemic. And, the projections are, even though we've had, Bed Bath & Beyond, Tuesday Morning, and some, major chains with store closings, the net effect for 2023 is projected to be positive absorption overall. So there's multiple resources in Bank of America, as well as CoStar and some of the other brokerage firms are projecting that. So there is an upside of continued pressure on the retail. We're seeing rent growth again. So the retail sector is probably in a position to handle the amount of space that's coming back through the bankruptcies over the next year and a half. Overall, this is not going to flush out quick. we've seen this show before. It takes time. We've gone through some price discovery. We're seeing values decline, but it's pocket to pocket. It's sector by sector and city by city. But at the same time, that is probably going to take at least another 18 months to flush out as some of those bad loans get worked through the system, which will reset the market. I mean, you look downtown Los Angeles, and Brookfield is, the core property owner for downtown Los Angeles on office. And, they're giving buildings back. They're stopping to make their payments. And a lot of owners on the office sector are saying, I'm not putting any more money into my building. The inflation impact on TIs and making the numbers work at the current rent levels, you cannot make the numbers work. So they have to have a price correction to get it back to a point where the demand you can still get an adequate return if you're buying into that sector. So this is going to take some time. It's going in that direction. It's been going in that direction. There's been a lot of discussion on, if you look at the REIT prices relative to the private sector, the REITs are down 40+% off their peak. So you have a tremendous disconnect between the public and private markets from the standpoint of how far the dip is going to go and how far when it's going to come back. There's always a correlation between the two, but the public market has the ability to be much more liquid and will often react earlier than the private market. But we are seeing, we do think this is going to continue for at least another 18 months. The pause and where interest rates go is going to have some impact on how long this takes to settle. If there is a future Fed reduction in rates, we could see this shortened at that time frame. If the rates remain high, it's going to take longer. But in my opinion, we're not going back to where we were on rates. That the fundamentals were there, the cost of capital was there to keep those cap rates that low. We're getting back to that level is probably not going to happen just because the fundamentals and the cost of capital are not going to return to where they were. I'll turn that back over to you. That's my initial take on things.
Thanks very much, Keith. And I'll just remind our audience that you can ask questions using the questions tab. And you'll see that in our dialog box as part of the go-to meeting. And we'll get to those. And welcome back our Government Relations Committee Chair, Justin Slack, to have and continue the conversation a little bit further. Justin, did you have any questions for Sharon or for Keith?
Yeah, I do. Thanks, Bill. Sharon, do you see any a role for validations or like relational values, like not less than or at least XX for users of appraisal services? Is that something that
Will you ask me that question one more time? Like a specific, I didn't quite follow what you were asking. I'm sorry.
do you see a role for validations in the market, like in the mortgage, for banks, where maybe an appraisal was done, a year ago, 2 years ago, 6 months ago, 3 years ago, and then coming back today to say, hey, the value is at least that, versus if they want to get these updates now. Excellent.
Great question. Sorry, I didn't follow you at first. But yeah, I think that many of our members actually do that pretty frequently. It's a year old. They're not quite sure the value's still there. I think, so many of our banks have really good working relationships with their appraisers to be able to, is it time to retouch this or not? I think the appraisal industry itself is such a value to lenders out there to be able to say, we're seeing declines we're seeing articles about declines, but I think that Keith really touched on it. So much of it is markets and locations and what you're looking at in your area. So I think that partnership of that retouch of the valuation or, to make sure that you're still in line, as you as the lender would have to document that, have there been a decline in the market, what economic factors are going to impact this loan as you touch these loans on a go-forward basis in your credit risk management. That is part of what you have to do as you manage your commercial portfolio. I see it done frequently in the residential area as well. Justin, you kind of alluded to that, and I think that that's really important. I'm going to jump in and respond to one other thing that Keith said as he mentioned Brookfield. I think that those of you who didn't see the article, they defaulted on 161 million in loans in the DC area alone, and it was over 12 office buildings. So, these are the softening of the edges, and you touched on it great, Keith, but I just happened to have just read that article last week, and occupancy rates were, I think, 52% in 2022, which was like a 79% decline from 18 to 2022. So that obviously is the hot spot, and I just wanted to add to what you had said on that.
I want to add one other thing to what you said, Sharon. And when we talk about the office market and the return, corporations are starting to say you got to come back to the office. And so the fundamental, there may be a hybrid structure, but they're also doing maybe a 3-day in, 2 days out, but they're having 3 days in all the same day for all the employees. So they really can't reduce their footprint as much as they would like to. The give back that's taking place, like in Silicon Valley's, I'll call it the tech markets across the country, including Austin and Chicago, the give back space is because they overexpanded beyond what they even needed in terms of what they needed. But if they are in 3 days a week, you still needed enough square footage to accommodate your entire staff. So that aspect of the market is what we're thinking is we're not going to see as much give back space as people think as the return to office continues.
I think that's a really good point. And from many of our members that have hired new credit analysts or new commercial loan officers that they're training in the industry, that this generation of new hires want to be in the office to be able to discuss the credits and be able to have those synergies. This is anecdotal, but this is what's being passed on to me, that many of the employees are very anxious to get back. And then others have said, I've heard it more on the compliance end, being able to have people work remotely. This has helped us really build a really good staff on compliance. So I think it's a give and take, and there's not a cookie cutter one way that it works where everybody's leaving and all of them are going to just totally flush out. I think that's a great point, Keith.
We have a shy audience tonight or today, so again, just a reminder, you can submit questions in the questions tab. Justin, did you have any additional questions?
Yeah, for Keith, I know you guys had your NCREIF Valuation Committee. You had a meeting recently, and just for maybe those that have missed it, was there any top issues or concerns that came out of that you can share?
There was a heavy concentration on discussion about where the office sector is and where those cap rates need to be and what's going forward. And we spent a lot of time discussing that. We had an office panel that discussed it, and not only, it's kind of some of the stuff I pointed on, but it was, what are we going to do with these office buildings that aren't going to be functional, aren't going to be, you are going to have a fallout of space because the gravitation towards the top tier, the best in quality, is part of the process of getting your employees to come back in. They want the environment, they want the amenities, those are the things that are getting the employees back. Going back to a generic, back office, I'll call it, or just class B and C office is not, creating the incentive to get the employees to want to come back. So we started looking at, okay, alternative uses. What are we doing with these buildings? And we had a discussion on, can you convert them to a multifamily? Can you convert them to life science? Those are the two cores that we kind of looked at and said, these are the two areas. Life science demand remains very strong in the core life science markets, the Boston, Raleigh, South San Francisco, San Diego, those opportunities, but you have to be in those core markets to really do a life science conversion. And there's physical plant aspects to the buildings too that will work for that. But we're also seeing conversion to multifamily. We're seeing a lot of it in DC, New York, Chicago's, incentivizing developers to convert their buildings on LaSalle Street to residential, which is what Chicago needs because they need more active people in that downtown market. And those buildings are not going to be backfilled with office tenants. It's a lot harder to do a conversion on anything, on the West Coast because of the seismic requirements and some of the other aspects. And a lot of buildings just physically, it would be, you can't do it. It's just the construction type, the way it's made. So we had a lot of discussion on alternative use, where the office market is. It's bad, but it's sectorally bad, location as well as product type. Then, and then overall, we'll discuss where cap rates are and how much, when you look at the industrial sector, where cap rates were in the 3s, and now they're, but you were buying a 3, but your rent was 40% below market in the core markets, or so it was so far below market. But the investor pullback we've seen has been, okay, I'm not going to buy at a 3, and I got a long-term lease, which used to be favorable. Now I got to wait 7 years to get any kind of real return when that lease rolls over because it's so far below market. So those cap rates have to move up, and they have. And we're now, you've probably moved your cap rates 125 basis points on the industrial sector over the last, I'll call it 18 months, really more 12, because it's really like mid 2022. So we've seen that move up. That was all, back to price discovery and where is the value going and what are the underlying fundamentals. And it really comes back down to, as Sharon mentioned, it is sector by sector and market by market. Trying to buy an office building downtown LA, nobody's going to give you debt, and nobody really wants it. But if you still have a good Class A office building in Santa Monica, yeah, the demand's there, the tenants are there. We still see the wall of money that is sitting on the sidelines to come into the commercial real estate market. It's never been as big as it is now. And they are raising more. Opportunity funds are being raised by the private equity side, the institutional side, that represents the members of NCREIF. They have to get the money out, and so it is, where am I going to put it? We've got to get it out. It's going to be a matter of when that money does get deployed. We think we'll see that alone will drive some of the values to stabilize, to if not start to increase. But there's a tremendous amount of money that's sitting on the sidelines to move into commercial real estate.
Great, thank you.
Sharon, if I could ask you to put your crystal, or look into your crystal ball a little bit on the regulatory side, what are you seeing or anticipating the agencies might focus on or emphasize the remainder of the year relative to commercial real estate?
Well, from the credit risk management side, I think they want to make sure that, your risk ratings are accurate. As I said, that forward-looking approach out for 3 years and so forth, that is really what they very much have expectations for banks to be looking at and doing. And we've spent a lot of time socializing that with our commercial real estate lending committee. How do you track it? You're looking at your dashboards every day. I think that the concentrations they're very concerned about with, if you're depending on your size, where are your concentration levels and how are you actually managing those? Are you taking new credits in and that will, one deal may push you over your internal concentration limits. So if you go over it, how are you managing the risk on that? How are you assessing the risk, and what triggers do you have if credits begin to decline? Your risk ratings begin to decline. Delinquency is not the only factor that they're looking at where we have such low delinquency, but managing it, should it be on non-accrual or, whatever the various touch points are when you're looking at it. So they really are highly focused on the management in credit risk and really how it flows and, your oversight of it. There are a few banks that we've talked to who are looking to increase a few of their concentration risks, but how they're going to manage it, how often they touch it, where they're looking at the risk, how it intersects the performance of the loans, the downgrades, the future management. Are they tightening covenants? If in 2 years, as this rate increases, we may have trouble in 2 years with this, so therefore they may be relooking at right sizing or the guarantor and the techniques that you do through your covenants, or adding some additional covenants to be able to get to where you need to adequately manage that space. I'm probably going a little too granular, but I want to make sure I covered the question.
No, not at all. We had heard and continue to hear there's some guidance under development on commercial real estate workouts. As there was a comment period of that last year. They've had that out, so it's an update to previous guidance, and that was anticipated at some point, and cover and encourage the outreach to the borrowers to at least start those conversations and start to look at workout possibilities and all of the scenarios with subsequent transactions. Are you all hearing the same thing there?
Yeah, I'll tell you that guidance, I recently just went through it again. There are some excellent examples of managing credit workouts on the commercial side, and it gives some excellent scenarios. And I know I talked to one of the regulators that worked pretty hard on giving those examples. I think ABA, in looking at it, they want to make sure that the accounting standards match what's happening with CECL and so forth, and there was a bit of a disconnect in that. So if you did look at ABA's comments, that's mostly what we were focused on. I don't see really an issue with what they put out there in their notice of proposed rulemaking. I think that there's a lot of good management techniques that many lenders can use regarding that, and I'm sure Justin probably has looked at it as well and can probably echo the same. I know it's coming out. I think that they're just trying to make sure that the accounting standards and everything is going to align. I asked that of we have tax and accounting specialists when he thought it would be forthcoming, and he did not give me a hard answer on when that final rule will be out. But we do expect it in 2023, Bill.
Yeah, same thing here. I know it was said to be imminent, but under development at the same time. So we all know how that goes at the agencies. There is a question from the audience and from Ken Dix. He asks, the St. Louis Fed has been showing declining deposits at all commercial banks since mid-2022. Will this have any impact on loan renewals, or will banks be reducing their loan assets?
I'm not a complete expert in balance sheet management, but I do know that the statistics that many papers and many articles are quoting are from 2022, and deposits really have stabilized. From what we're looking at, we look at these numbers at the end of each week. We have to realize a lot of the PPP monies at the end of 2022 were naturally rolling out from many of the institutions. It's not a question of capital, that's some of the liquidity. Many of our banks have said that, their deposits have been holding, and some have seen some outflow naturally from monies that came in from the government and from PPP. Well, that is the government, but from the PPP funding that came into many of the banks, and the businesses are now using those funds for whatever purposes they need. So I hope that answered it, but from the numbers we're seeing, it really seems to have stabilized as far as the liquidity funding.
Yeah,
I don't know if I totally answered the questions. I'm not sure that there'll be a reduction in assets, to answer the second part of that, but I think that the focus to make sure that the diversity in the commercial loan portfolio, you have diversity, because I think that's the stabilization for commercial lending. You're not highly focused on one specific industry. So if there's issues there, then you begin with all of your commercial real estate assets. I think that there's some slow, breaking involved in some of the industries that Keith and I have been discussing.
You got it, Sharon. Thank you.
Sharon, what's the size of what's the typical bank size in your membership?
We represent small, regional, and large banks. We're not focused on one or the other. So I can't even tell you what the average is. Maybe membership could for the average bank size that we have, but we talk to the big of the bigs and the regionals, as well as really those what I'll call the small community banks, which is where I cut my teeth. I'm a former chief credit officer at a small community bank.
And just the NPV's practice, we do over 300 billion a year in valuations, 3,400 appraisals a year. And 50% of that is on the equity side, 50% of that is on the debt side. Regional banks, large commercial banks across the board. We're certainly seeing a lot more requests coming in, loan watch, loan special servicing, where, as opposed to new originations. It's shifted dramatically in the last, 2 quarters, where now we are, getting these, or we just want to relook at our entire portfolio on the office sector because we know we got great exposure there. And so I'm seeing the banks step in and have to, and it's being driven regulatory wise or just, credit risk management. But we're definitely seeing an uptick in that and how and this goes from the big banks down to the regional banks. We're definitely seeing the concern there from the banking sector.
Yeah, that's a great point, because that is exactly what's happening. I think it's, as I said, that forward-looking risk management and retouching, and we're concerned about this one sector. How should we shock it? What are the things that we really need to be focused on? I think that a lot of it comes from really prudent credit risk management for the safety and soundness of for our members and their balance sheet. But the regulators are talking about it. They're coming in. I'm not sure that there's been necessarily a heavy-handed exam, where it's coming in and they're just get rid of these assets. The regulators really are focused on working with your borrowers, helping them out short and long term. And that has been their message. It's their message in the commercial real estate notice of proposed rulemaking bill that you referred to on commercial workouts. And it's been all through the pandemic in everything the interagencies have published as well. So I think that's a great talking point, and thank you for bringing that up.
Looks like we have a question in the queue for Keith. It was mentioned that institutional investors are part of the wall of money that will return to the market. Are many of their portfolios not already over allocated in real estate?
Very few are over allocated in real estate. But when the stock market shifted last year, it did mess up with some of the allocations because their equity investments, because of the decline in the stock market, when they do their portfolio allocation and they look at where their real estate is, it did move it some. But most of the funds were underfunded in that sector anyway. And when I say institutional money, there's that side of it, that are money managers for others. But there's also the private equity guys that are raising money. You got the Blackstones, that are out there raising, funds for opportunity funds, getting ready because they're going to be out buying these loans. Some of the major banks have gone out and they've shopped the loans that they feel like they got too much exposure. They were shopping the loans as opposed to, get it off their books. And those private equity guys, so it's part of that wall of money I refer to, and it's private equity, it's the institutional funds. There's the sovereign wealth funds from around the world still want to buy U.S. real estate at some point in time, but it's a pause. It's a pause until they see some clarity. I think when you see the feds ever move a rate down, if and when that happens, you'll see some of that money start to come in.
Thanks for that.
And to add to that just a little bit, which is a total, I'm hitting soft snow, I'm a skier. When you look at deals that were looked at in the banking sector in the fall, they're not right sized today with that 475 basis points increase. So I think, that's had for new production, a lot of folks who were going to, get involved in a project and so forth, a deal that worked previously is not necessarily working today. And there's still been, as you said, some private equity monies that have gone into it. But I think the funding, as we know, has slowed down in the bank angle, because really that debt service coverage, looking at the projections or, the numbers themselves may not have carried it. So that's just a point I thought of, Keith, as you were talking.
Yeah, and that brings up, in thinking about that too, the bank sector, while the banks may be pulling back on their lending, we are seeing some of the mortgage REITs and some of the alternative lending groups step in and, say, I can backfill this at rates I couldn't get a while back. So there are going to be some alternative type of lenders that are going to step in and fill some of that void. They cannot fill the entire banking void. It's just the size is too great. But there are some funds that have put together that are going to be the lender of last choice, and that will backfill some of the bank softness.
Yeah, and that's a good point. And many of our lenders are like, we're going after good deals. There's really good deals to be had in our marketplace. And as she said, a lot of it's location, the property type, and how it looks. So, there is a good side to it, that, strong underwriting criteria and so forth, that there are some very good deals still out there to be had. We have to keep this on a bright note.
I was just going to ask about special assets. So, Keith, you mentioned that a little bit. Can you talk a little bit about the timeframes? You're starting to hear some of those departments start to gear up right now from an appraisal standpoint. What should they expect from special asset managers this year?
Well, the special assets and special servicers, and they look at assets from a different perspective than the lending community. And they may be interrelated even, but they do have a different perspective, because they want to clear that asset. If they do take it back, they want to know what they can clear it at, which maybe I have to do a distress sell, or I may have to sell my note at 20% down to move this. But we're also seeing, it may go into special servicing because the lender or the borrower has, not met the covenants, but they're not necessarily going into foreclosure. And the banks are just saying, well, let's wait. We got a good borrower. Let's see if we can do a sweep on the income. Let's look at all our alternatives before we go to, I'll call it a fire sale, or, pure right into foreclosures. I never met a bank that wanted to own an office building, because of the bad loan. And they, I think they've proven, they know they're not very good managers of real estate sometimes when they get into that special servicing or into foreclosure mode. So that aspect of it, it will, all that debt that's coming due that is going to have to clear. There's going to be a reset in some of the pricing on assets, across the country, particularly office. It's going to have to, but it's a matter of time. And until those transactions start to become more of the market, more of the norm, and as an appraiser, you're looking at that. Is it a distressed sale? Is it market, or is this a distressed sale? What is really going on? I want to touch on one other sector too. When we talk about asset classes, and how much cap rates have moved, I'm thinking from an institutional perspective. When you look at a office building, 50% lease compared to one that's got 95% lease with a quality rent roll, that spread in cap rates has grown dramatically. So while we're saying that that's going to have to clear, but those assets that have problems, that have big holes in them, big rollover exposure, those assets, those cap rates have moved tremendously more, just because you're down to your only buyer is an opportunity buyer that feels like he's taken on a lot of lease up risk. So the cap rate spread between your core, I'll call it your core assets, compared to your assets with trouble, is dramatic. And those are the ones that are going to clear first when they start getting into the bank, because they don't have the cash flow, to meet, they don't even see the cash flow to meet the debt service. So it's when those come due, it would be very difficult to, any kind of refinancing. So those are going to clear first, and, more so than any of the Class A assets.
To follow up on the question that you asked, Bill, from what Keith covered, which are really good points, a lot of what they're hearing from special asset departments and so forth, you got to realize a lot of it is very collaborative it is almost preemptive, exactly what he's saying, that, here's the class of assets we're concerned about. Their special assets is getting in early, and that's part of that forward-looking management we're talking about. We know, and is exactly what he's saying, and X amount of time and so forth, repricing is going to take place, that the management of these assets. So that's getting that appraisal in early to look at those valuations gives the bank the whole, cross section a really good idea of what's happening. It's funny, one of my members was saying she sends her commercial loan officers up front, boots to the ground, visiting office space, visiting hotels, making sure that, the parking lots are full, that it's not dark. And they're really touching these properties early and then discussing, do we have a little problem somewhere along the line in the future? And the fact that they're still performing, I think, in the fact that it's so hands-on right now is very much part of it. So that was a great point you brought up, Keith. Thank you. I just wanted to add a little bit to it.
Thank you both for that. So we've got just a couple more minutes left, Justin. Please jump in with any final questions or thoughts that you have.
Yeah, I just wanted to see if Sharon could briefly touch on or add to what she sees, like what can appraisers do to help, like with either underwriting, mitigating underwriting issues or credit, like things that maybe credit officers want to see. Like, what is there something in an appraisal reports that we can include that would be helpful, do you think, on that side of the house? Besides just value, right? Like the value is X, great, but is there other things that we can report on?
I think I'm off mute again. It's funny because a lot of what is in that commercial real estate workout proposed rule, they talk about the bank itself challenging the assumptions that went into the original appraisal and looking really into the depth of a lot of went into it. So I think that dialogue that the banks will be happening with their partners, the appraisers, to say, okay, we're looking at these assumptions. Can we rediscuss them? Are they active today? Are they not active today? That's a huge piece of that appraisal management. Is the takeout commitment? Are you seeing, things within the market that may impact the fair value of the appraisal that was originally done? Is there different facts that have changed? Are there different approaches to the collateral valuation that might influence whether or not it will, perform in the future? Is vacancy change, absorption rates, the lease renewal trends, anticipated rates. I think that that's the information so many appraisers have, and I've only touched on a handful of them, that it is really, really valuable to a financial institution.
I am getting those calls every week from people who did loans 24 months ago and saying, what assumptions would you change today? And they're not ordering an appraisal, but they're internally revaluing some of these assets, and they want to know, what are the changed assumptions that you did 18 months ago? What would you do today? And they're trying to get very realistic. They're asking the right questions. So we are getting those calls on a regular basis.
Keith, you've been through this kind of cycle before? You're seeing it firsthand and talking with user community. What advice do you have for appraisers looking ahead?
You got to look for all the data points. I mean, you may not have a transaction, but look at the transactions that went to market and then collapsed. Talk to the brokers. It's going to take you longer to do the appraisal. You got to spend more time on underlying assumptions. But you have to talk to the market, and you don't have a sale, but you've got one piece of data, and you start bracketing it and trying to narrow it down with whatever data you do have. Look at the underlying fundamentals again, but it's talk to the market participants. Get out. Don't assume what was good 12 months ago is good today. The market will move fast when things start to clear.
Final word, Sharon Whitaker.
Thank you for having me. I've learned a lot in this discussion, and I thank Justin and Keith, and you, our host, of course, Bill, for having me on. And I just look forward to, to continued dialogue and discussions because we're all partners in this.
No question, Sharon. Thank you for joining us today. Keith, thank you very much for spending time breaking away from the NCREIF conference, and Justin, your leadership, as always. We appreciate all of your perspectives. We will see you soon on our next GRC call from the Appraisal Institute. Thank you all very much for attending.
Thank you.
Thank you. I don't know how to hang up on calls, so my apology. I'm trying to get off. Leave the webinar.